Financial management has to take important decisions with regards to the following three problems. Let us learn the first one, decision related to investment. Now, long-term capital is invested in fixed asset. Which assets are to be purchased and how will be selected by the finance manager. In taking the investment decision, elements of risk and returns are to be considered. Various methods of capital budgeting should be considered. Method of net present value, payable period method, return on capital employment, cash flow, etc. should be used. The factors affecting investment decision are need of total capital, estimated rate of return and profitability receivable in future from investment, estimated cash flow receivable from investment, element of risk involved in investment, requirement of working capital after investment, useful economic life of investment and its estimated life, significance of investment, capital rationing, and certainty or uncertainty of earning in future. Now, second is decision related to financing. Investment decision relates to assets of the company. Financial decision relates to capital structure of the company. Capital structure of the company consists of equity share, preference share, debenture, etc. Capital structure is the mixture of various forms of source of capital. It is dependent on requirement of funds and the purpose of requirement. Proper combination of sources of funds will create a proper capital structure for the unit. Factors affecting financing are internal factors and external factors. Internal factors are type of business, nature of business, size of business, growth of business, and financial requirement, nature of assets and requirement, attitudes of directors. External factors are the condition of capital market, floating cost of securities, then attitude of investors, rate of interest prevailing in market, legal restriction, and institutional investors. Now, the third is decision related to dividend. Shareholders buy shares with some assumption of returns. Dividend is the part of profit that the business unit gives to the investors. Dividend can be paid from the profit. The finance manager decides the rate of dividend. After deciding the amount to be retained in the business, the finance manager decides the amount to be paid as dividend from the remaining profit. Payment of dividend affects the market value of the shares. Plowing back of profit and dividend are inversely related to each other. More the dividend, less will be plowing back of profit. So, factors affecting dividend divisible profit of the company during the current financial year, estimation of income in future, rate of dividend paid by the company in the past years, need of plowing back of profit in business, financial condition and financial needs of company at present, ratio of reserves with company, future planning of profitable investment, attitude of directors of a company, taxation policy, legal restrictions, expectation of shareholders of the company, condition of capital market, growth rate of company, liquidity position of the company. Let us learn about capital structure. There are two important aspects of financial plan. Problem of capitalization, that is to estimate need of capital. Problem of capital structure, that is to determine source of capital. Company can obtain necessary funds from various sources. Company can go for equity share, preference share or any other securities. The financial manager has to decide what proportion of various securities will the company opt for. According to Justenberg, decisions regarding type of securities are reflected in the capital structure of the company. According to Hogland, capital structure means proportion and magnitude of different securities issued and sources utilized by a company to raise its funds. Let us learn the characteristics of ideal capital structure. First is simplicity. The company issues lesser type of securities, the capital structure becomes simple. In other words, if possible, the company should go for less combination of securities. Second, profitability. The capital structure should be such that the company earns maximum profit. Third, adequate finance. Whatever is the requirement of finance should be fulfilled by the various combination of capital structure. Fourth, flexibility. Capital structure of company should be flexible so that it can be changed as per the requirement of the circumstances. Fifth, economy. Care should be taken about cost of capital. Finance managers should see that the cost of capital is minimum and the finance required is also met. Balancing. There are two types of funds, owner's capital and borrowed capital. There should be a proper balance between them. Liquidity. Necessary provision should be kept in the capital structure for liquidity. This will help in making payment of debts. 8. Attractiveness. The capital structure should be kept attractive. It should attract the investors. Care should be taken about all the class of investors. 9. Solvency. Proportion of borrowed capital should not be so large that the burden of interest cannot be borne. It happens so, there is always a risk of a company becoming insolvent. From the above explanation, it becomes clear that what type of combination should the company have in its capital structure. You can see the types of capital structure. Let us learn the internal and the external factors affecting capital structure. Internal factors. First is the type of business. There are two types of business unit, manufacturing unit and trading unit. Manufacturing unit requires more fixed capital, whereas trading units require less fixed capital. So on the basis of this, you have to decide the type of capital structure. Second is size of business. Large business unit requires more capital, small business needs less capital. Hence, size of business unit determines the requirement of capital. Third is estimation of business income. Income is uncertain in any business. If the estimation shows handsome income in the future, business can go for borrowed capital. Fourth, nature and requirement of assets. If the requirement of fixed capital is more in any business unit, the best way is to go for equity capital. If the requirement is less, then one may opt for hire purchase or installment purchase. One may also go for lease contract. Fifth is attitude of directors. If the directors do not want to share management with others, then they will not issue more equity share capital. If directors are comfortable in sharing the management and want own capital, they may go for equity share capital. Sixth is financial requirement. Finance is required for many reasons. If short-term requirement is there, one may go for equity share capital. For large-scale finance requirement, one may issue other various types of securities. Seventh, duration of capital requirement. Permanent capital requirement can be fulfilled by equity share capital. There are many sources of various short-term capital requirement such as bonds, preference share, debenture, public deposits, etc. External factors. First is condition of boom depression in capital market. During depression, investors prefer debentures, and during boom period, their choice is equity share. Based on the current capital market situation, selection or combination of capital structure is to be made. Second is present rate of interest in capital market. If the current situation, the rate of interest is very high, the unit may issue equity share. The reason is the business unit does not want the burden of high interest. If the interest rate is low, the business unit may go for debenture. Third, cost of capital expense of issuing securities. When equity share capital is to be issued, various expenses are to be incurred. Issue of prospectus, underwriting commission, brokerage, deposit with SEBI, etc. If the business unit feels not to spend extra money for expense, they may go for debenture or any other source of capital. If the business unit is ready to spend money and interested in own capital, they will go for equity share capital. Next is legal restriction. Rules of SEBI, RBI and Provision of Company Act affect the capital structure. Taking into consideration all these policies, proper capital structure is to be selected. SEBI means Securities and Exchange Board of India, RBI, Reserve Bank of India. Fifth, taxation policy. Interest to the debenture holders is considered to be an expense for the company. If the company wants to show less profit and pay less tax, it may go for debentures. If the company wants to go for equity share capital, the amount of dividend is tax-free. Next is institutional investors. Insurance companies, banks, financial institutions of state and central government, etc. invest in shares and debentures as per their policy. Before going for any combination of capital structure, these provisions are to be considered. Seventh is foreign institutional investors. After proper registration with SEBI, the FIIs invest in our nation in various companies. If this FIIs are investing in our nation and our nation is their prime priority, we may go for equity share. FII stands for Foreign Investment Institution. From the above discussion, we may say that appropriate capital structure decides the profit or loss of our unit. In other words, the success or failure of our institution depends on capital structure.